Demystifying Ipsas 43. Good evening, we are here today, October 25th, 2025, to discuss a critical topic. Specifically, International Public Sector Accounting Standard 43, leases. But the user's brief concerns non-exchange revenue, which is governed by Ipsas 23. To maintain accuracy, I will frame this lecture under the correct standard. Ipsas 23. Ipsas 23 explains how governments recognize and measure revenue received without giving equal value directly in return. Think of it as a one-way transaction. Resources in, no direct equivalent out. Non-exchange revenue is received without providing approximately equal value back to the payer. The opposite of a commercial sale. You buy a car, you get a car. Governments instead fund collective services. Taxes are the prime example. You pay the FBR, you do not receive a personalized good in return. Your payment is pooled and used for defense, roads, schools and healthcare for everyone. The benefit is collective and indirect, not a one-for-one exchange. Grants and aid. Donors receive no commercial product. Their return is policy outcomes, health and infrastructure. Fines and penalties are also non-exchange. Payment without direct benefit. Most government revenue is non-exchange. Ipsas 23 provides the rules, so statements show a clear, faithful picture. Recognize revenue when the government gains control of an asset. Ipsas 23 applies 3 tests. First, a past event creates the right, for taxes, earning income or making a taxable sale. For grants, signing a binding agreement. Second, the inflow is probable, more likely than not. A signed assessment or reputable grant meets this. A vague pledge may not. Third, the amount is reliably measurable, easy for cash, valuation needed for assets in kind. All 3 must be met before posting revenue. This prudence prevents overstating income and keeps financial positions realistic. Accurate recognition improves budgeting, planning, and credibility with citizens and lenders. For accountants in Islamabad or Karachi, the question is timing. Exactly when does control pass and measurement become reliable? Apply the tests. Past event, probable inflow, reliable measurement. When aligned, recognize revenue. Otherwise, wait. Consider tax revenue, collected by Pakistan's FBR, income tax, sales tax, customs. Under Ipsas 23, you cannot book the whole year day 1. Wait for the taxable event that creates the claim. Income tax arises as income is earned, individuals and companies. Sales tax arises on the sale of goods or provision of services. Revenue is recognized when the taxable event occurs, not necessarily when cash is collected. Reliable measurement uses history, models, and declarations to estimate earned but uncollected taxes. Record an allowance for doubtful collections for prudence. This ties recognized revenue to real activity, improving analysis and forecasting for policymakers. Ipsas 23 distinguishes grants without conditions, recognize immediately, and grants with conditions, record a liability. Unconditional $10 million received and controlled is recognized in full-on receipt. Conditional grant for a highway is first a liability. Funds may be returned if not delivered. Record obligation to perform before recognizing revenue. As performance occurs, recognize revenue progressively, reducing the liability. 20% complete in year 1. Recognize 10 million. Reduce liability accordingly. Match revenue to obligations. No premature windfalls. Rule of thumb. Control and conditions determine timing. Measure non-exchange revenue at fair value, the market price at the measurement date. Cash is straightforward. 10,000 rupees equals 10,000 in value. For donated assets, determine fair value objectively, no arbitrary numbers. Use professional appraisals, considering location, size, condition, and comparable prices. If no active market exists, estimate replacement cost. Then, adjust for age and condition. Depreciated replacement cost. Aim for values that are objective, verifiable, and reflect economic substance. Recording fair value supports accountability and stewardship of all public resources. Adopting Ipsas 23 needs a plan. Learn, map, assess, measure, update, train, test. Step 1. Train finance and audit staff on non-exchange, recognition, and measurement. Step 2. Map all income sources, exchange versus non-exchange. Step 3. Identify control points and grant conditions. Step 4. Set fair value policies, market appraisals and cost techniques. Step 5. Update systems, chart of accounts and procedures for liabilities. Step 6. Train program, grants, and tax operations teams. Step 7. Pilot with real data, review and audit before go live. Expect hurdles, record quality, skills gaps, legacy systems, and legal or estimation challenges. Digitize and centralize grant and tax documents early. Invest in ongoing training and a train-the-trainer model. Upgrade or procure Ipsas-ready FMIS modules. Roll out in phases. Build estimation models with economists and align statutes with Ipsas in consultation with legal and policymakers. Addressing these methodically ensures a smoother transition and audit readiness. The payoff: transparency, accountability, better planning, donor confidence, and audit readiness. Stakeholders get a full, honest picture, including terms and conditions attached to revenue. This strengthens governance, improves economic management, and builds international credibility. For Pakistan, embracing Ipsas 23 elevates public finance from reactive to strategic, serving the public interest. Thank you for watching.